Welcome to Bunnex Investment Group. Today we are going to review an effective sniper entry strategy. Most traders wish to actually get these kind of entries. So this is very easy to follow and consists of picking high frequency supply and demand zones. If you are new to this channel, consider subscribing so that you won't miss any new content. So in this video, we are going to talk about high frequency supply and demand zones, supporting indicators. We need these indicators to actually locate these high frequency supply and demand zones. Then the complete sniper entry system is now a consolidated summary of everything that we would have talked about. And then last but not least, chart examples of practical markets. So this is very important. Don't miss this to understand the system. Before we get into our today's content, we have an advanced course for those who want to take their trading to the next level. This will focus on institutional market maker method and is going for $85. If you need it, please contact us using the links in the description box below. So this will focus on levels counting, peak resets, how to determine points of entry, entry criteria, the only patterns to focus on, and several stuff. So the first topic that we have mentioned earlier is supply and demand zones essentials. So basically supply and demand zones are points where a lot of orders once located. So it's basically points whereby there was a large number of buys and sells. So usually that point becomes a very powerful point of reversal in the future. However, a lot of texts on this matter defines these zones as simply points where market bounced once. So following this will result in you getting a lot of losses in your account, because you would see several contexts will say whenever price comes to this point, we have this point as a resistance point. So in the future, we would expect to see the market coming back to bounce and give us entry points. Of course, some of the times it happens on the markets, but it is a lower degree of occurrence than what we'll review in this particular video. So before going any further, we need to define the only support and demand zones you respect to catch sniper entries, no matter the time frame. So it doesn't matter, you'll be looking at the daily time frame, the H4, the M15, the H1 time frame, but you will be using the same concepts. So the zones that we are talking about or in this subject are these ones. The first thing is we need to locate the previous market flow. Where was the market coming from before we are at the point of determining an entry point? So in this case, the market was in a downward trend, and after that downward trend, we had a market reversal. So the possible points of reversal are actually derived from the previous market flow. These are the only points that we'll start respecting after watching this video. So the first point is actually the last lower high, like this one, the last lower low, and the last neckline. That is in an upward market context. So in this case, we would expect to see the market bounce either from this point, or from this point, or from this point. However, there is a technique that we'll talk about later in this video, which will actually help you to pinpoint which one is the rightful zone of reversal. Then in a downward market context, we actually take the inverse of what we have mentioned earlier, the last higher high, the last higher low, and the neckline. So in this case, we would expect to see the market come either bounce here or here or here. Also, you need to apply the technique that we are going to talk about in a few slides. So that technique will help you to choose or to locate the rightful point or zone of market reversal from these zones. So supporting indicators will actually help us to locate the rightful zone of reversal. So if you saw from the above illustrations, we have different zones of market reversals, and we need indicators that will help us locate the right zones. So the 13 and 50 EMA will help us pick the correct zones on the market. So the theory of zone selection, right, is now a theory that will govern us which zone to locate or to select from the zones that I've shown you. So the theory of zone selection states that after a 1350 EMA crossover, that is exponential moving average crossover, on any time frame of your choice is issued, price will pull back to the 50 EMA and pierce through to the nearest supply or demand zones. So what we mean is, after we have this previous market flow, the market is reversed. Usually in this particular move, we have a 1350 EMA crossover. After that has occurred, the next thing is we'll see price coming back to the 50 EMA, right? To that 50 EMA, it will pass through or pierce through that 50 EMA to retest either, in this case, the last lower high, the last lower low, or the neckline. So the nearest demand or supply zone to the 50 EMA, in this case, this one or this one or this one, is the one that we will respect. If you can't get this, we are going to have more examples on the charts. So basically, the price will pull back to the 50 EMA to retest the nearest zone of supply or demand. So in summary, what we are just talking about is, on any time frame of your choice, you will need to follow these steps. The first one is wait and see a 1350 EMA crossover. Mind you, these are applied to the closing prices of candlesticks. Then mark the possible zones of reversal as shown earlier. That is the last higher high, last lower low, or last actually neckline, or the last lower high, last lower low, or the neckline. You have to mark them all. Then after marking them, observe which zone is the first to be retested after price pierced through the 50. Basically, we are trying to say the nearest zone to the 50 EMA below the 50 EMA or above is the one that we anticipate to see the price retesting. Then after price retest these zones, you enter the market and wait for the market to play out. So let's have more examples on the charts to fully understand what we've been explaining. So this is euro against dollar, and we are going to do the same exact steps that we were talking about. This is on the H4 time frame, and we have another example on the H1 time frame. So on this H4 time frame, we've said the first thing is actually to locate or to see a 1350 EMA crossover. In my case, my 13 is in red and my 50 in blue. So the first thing we've said is to actually see a crossover like that. After that crossover has occurred, we now need to mark these zones that we have been talking about. In this case, our previous flow was actually this short-term upward flow. So from that short-term upward flow, where can we see the last lower high, the last lower low, and the neckline? Basically, we do not have a neckline because there was no double top issued at this point. But in this case, we can see that we had this as our last higher high, our last lower low, last higher high, last lower low, like this. And the price came back to this nearest. In this case, this was not near. We respect the one that is above the 50 EMA in this downward context case. So this one is the one that was above the 50 EMA. That is the one we were waiting to see price come back and reject from, right? Then after that, we can also see another crossover that has been issued at this point, right? After a crossover of 1350, we mark the first one, which is the last lower, in this case, lower high, the last lower low, right, and a neckline, right? In this case, we may take this as our neckline. So which one is the nearest to the 50 EMA? This one is above the 50 EMA, therefore it is out of scope. We'll remove this one. This one is further away from the 50 EMA, therefore it is out of scope. So the one that we were going to respect was this one, and we waited for price to come back and retest, and our entry was actually met. In this case, what can we see? A 1350 EMA crossover has been issued. After a 1350 EMA has been issued, we wait, or we mark our zones. So in this case, this was a zone because it was the last lower high, then the last higher high is this one, and the neckline, which is this one, right? So in this case, which were valid, this was not valid. Why? Because it was below the 50 EMA. We respect the one that is above the 50 EMA in this case, and this one was the right one. Therefore, we waited for price to come and retest that zone. In this case, it was retested and our entry was met. Then on GBPUSD, we have another examples, and this time around is an H1 time frame. So in this case, the first thing was to locate a 1350 EMA. So starting from this point, we had a crossover here. After that crossover, we had this previous market flow. So from the previous market flow, what can we see? The market was in a straight drop. There was no clear lower highs or lower lows. In this case, we only had a neckline since we had a double bottom. Therefore, that is the only point that we had, and in this case we may see that the market actually came back to retest that only point that was available to us. Then after that, so to actually use this methodology, if you have the knowledge of levels counting and resets, you'd see that it will be very easy and more accurate. So levels and resets are mainly discussed in our advanced course. So you may check our advanced course to actually learn more about our system. So after that, we can see the market giving us what we call a reset or a cycle restart. So from that reset, it was a peak, and after that peak, we got a 1350 EMA crossover, which was issued at this point. After that 13 EMA crossover, what was the flow, the previous flow? We had this as the previous flow, an upward flow, then the last lower low, last lower high, and the neckline. Therefore, we actually marked 1, 2, and the neckline 3. Which one was the nearest to the zone of reversal? This one was actually the one that was going to be correct. Therefore, we can remove all the other ones. So you can see the market actually respected this point. Then the next point, we can see that after the crossover of 1350 EMA, the market went down. Then after going down, which were our zones? We had 1 and 2 and 3. So as we can see, which one was nearest? This one, the lowest one, was the one that was nearest to the 50 EMA. Therefore, price actually came back. It could not retest properly, but we could actually get this off having rejection of this zone. So candlestick rejection is actually one of the videos that we'll be releasing very soon, so that you'd see how to enter after the OK. Then after that, we can see also that we had a crossover here. After this crossover, which zones did we have? We had 1, we can see from this previous flow, last lower high, last lower low, and the neckline. 1, which is already above the 50 EMA, therefore not valid. Then 2, which was below the the 50 EMA, and then 3, which was the neckline, also above the 50 EMA. Therefore, this was the valid one. So that is where we could enter after seeing candlestick rejections. So candlestick rejections are very important. You need to see the zone that is experiencing several candlestick rejections as a sign of reversal. So that is the exact point that you will enter the market after you see a zone being rejected. So in summary, what we have been talking about is the first thing is to see a 1350 EMA crossover. If you know how to count levels, we would say seeing a peak is of fundamental importance, and after that peak has been issued, we need a 1350 EMA crossover, a level 1 flow. After that level 1 flow, then a pullback to the previous supply and demand zone, which has been derived from the previous flow, and then candlestick rejection of that supply and demand zones. So if you would like to increase the accuracy, you will need a pattern that meets our trading criteria. That now is in our advanced course. So we have come to the end of this video. Thank you for watching. Like and subscribe.